we go.
Good evening, good afternoon, everybody. Hope everybody's doing well. Happy New Year to everybody. We're going to wait a couple minutes just to let a bunch of people get in. We had a ridiculous number of people sign up. That was no football games, no hockey games, nothing exciting going on. So you guys wanted to hear us. I believe we have over 650 people that registered for this tonight. It's pretty exciting. We have the world famous Trevor Thompson on. Very exciting to see him. Let's go try to go to your meetup Monday night. John won't let me go down to Austin Monday night though, so apologize. But a shout out for the meetup in Austin Monday night. Sammy is on. That's exciting. This is my, these are the old days when I used to do Tuesdays with the teams where I would just go and search for people's pictures. I see Hector on. It's very good. He's not looking at the screen, but that's okay. There you are. Yeah, I know. Andrew Lee, everybody shout out to Andrew. He's, Andrew came and joined us. He's our new asset manager. So he's doing a very good job, extremely good job overseeing, there's about 21 assets right now. Then we have the world famous Aaron Katz, who I have not seen this year yet, but I've got quite a few emails from him today. Good to see Mr. Katz. Let's see who else I can call out. If you're sleeping during the portion that Anna's going to talk about, I'm going to call you out on here. So if you want to take a nap, just make sure you turn off your camera. So I'm going to have a little fun since it's the beginning of the year. Most people turn off their camera, so it's going to be hard to make fun of some. What time do we have, Jeff?
We're at 6:03. Still letting people in.
Yeah, wait a minute and a half. Let's see who else I can make fun of. I see Israel is on. Not making fun of him. Israel, how's everything going? How's school? You staying in school? Thumbs up for staying in school. I didn't unmute you yet. This is great because I can talk to you and you can't talk to me. If I could do this with my children, I would be the happiest human being alive. Let's see. Hector's wondering why he signed up just to listen to Merrill talk. Erica's probably thinking the same thing. And who else can I make fun of? I can make fun of John Monteiro, my partner in crime. Jeff King at the bottom, Mr. Insurance. So we'll give it about 30 more seconds. Then, as you guys probably guessed, we're going to talk a little bit about the economy. I know it's not a very big topic or important topic. 2022 was pretty boring, as was 2021 and 2020. And then kind of what we see, not as experts, none of us are economists, even though Mr. Monteiro has an economics degree, never claims to be an economist, but probably listens to more economists than anybody I know. So I call him the economist. And Anna will probably talk about things that are so complicated, I'm not going to understand it. I'm going to have to ask questions in my own webinar. But the format will basically be, we're going to try to spend about 30, 40 minutes talking about kind of real quick where we were, what's going on in 2022, ultimately what we see could happen in 2023, obviously with a lean towards multifamily, but we're not going to get into actual multifamily strategies. We'll save that for the next webinar, which we hope to do around the same time, first, second week of February. But at the end, we're going to allow whoever has questions to either type them in the Q&A box, the chat box, and at the end, we'll ask you to unmute. You can ask the question. Or if no one had any questions and everybody was sleeping and they wake up at the end and want to ask questions, you can raise your hand. There's a little icon somewhere on the screen. Jeff can probably explain it better than me, but that allows you to raise your hand and ask a question, and then we can click on you. So Jeff, I think I'm going to start. This is recorded. This is for informational purposes only. That's me as a lawyer saying that. And I'm going to start off by basically just saying we're talking about 2022 economic challenges. I think there's probably nobody listening that didn't have some sort of challenge. A lot of you guys, quite a few of you guys are actually investors in some of our revision masters deals, and everybody seems to think everything went so smoothly, and we never saw any issues or any problems with lenders whatsoever, right, Sean? Never had a lender back out on any of our deals this past year a week, or change the terms the night before we signed the docs. So yeah, we can't even imagine people saying stuff like that, because it could never happen to an SEC lawyer. Clearly, I'm being facetious. We went through the same garbage that everybody went through. Let's go to the next slide, Jeff. Thanks. Real quick, I'm just going to tell everybody kind of what Revision Masters did this year through the, we're going to call them economic challenges, because these challenges always create opportunities. And this obviously is me as a former bankruptcy lawyer who's seen the worst in companies, see opportunities that are always created, but you always have to be careful. So we started out strong like everybody else did, but most of we ended up picking up 25 multifamily properties with our partners. And most of those were actually between March and the end of this year. So the feds had already started playing with the rates and trying to curb inflation, which we're going to get into. So we are pretty excited we were able to do this. So we picked up 25 assets with some great partners and absolutely great investors and top-notch property management companies. Average occupancy across the board was 95%. Average units per assets, 211, total of 4,743 units. That's why I mentioned Andrew Lee at the beginning. He's got to oversee all 4,743 units with no help from us whatsoever. I'm kidding, but he definitely helps us out with that. It's in a total of 15 cities, a little deceiving. It's DFW, Houston, Austin, those MSAs, and then Raleigh, North Carolina. You've heard us talk. We think Raleigh looks just like Austin, less traffic, not as California, but very similar to Austin with technology and all sorts of research centers surrounding it. So our total asset value as of this moment is $793 million under management. Average year built was 1983. And we raised $130.3 million this year. Much easier at the beginning of the year than it was at the end of the year. Though we still didn't have any issues, but it definitely was a little bit slower than the beginning of the year. And then in blue, if you're following us, we're very bullish on multifamily development, especially with the compressed cap rates. And the reality is, at least in the markets we're in, there's not been a whole lot of relief on compressed cap rates. Maybe they've gone up 25 to 50 basis points, maybe. So the cap rates are still very, very low. And it's still, even with some of the price increases, which have come back down now, and some of the labor issues, it's still less expensive to build an A class than it is to buy a B plus in DFW, Houston, or Austin. So we're still bullish on that. This is all just in the last year. We've picked up 8 projects, all land deals, all off market. Everything we have is off market. When they're ultimately finished, there'll be a total of 12 apartment complexes. They're in 7 cities, again, DFW, Austin, Houston, metros. And the ultimate value, and this is years off on one of the projects, is about 1.4 billion stabilized, assuming market conditions are where they are now. And all these numbers are subject to market conditions. That's me as a lawyer saying, okay, I'm done. So anyway, this is just to show you guys that there's still opportunities out there. We're still looking at opportunities right now in January and February. What was not a good deal in August has come back to us in November, and then came back to us again right at the end of the year. Just bad timing for us to try to pick a property up at the very end of the year. But we saw price reduction go from 50 to 42 to 35 million on an Austin property. So there are opportunities, especially with people that have to exit their properties almost unwillingly because of the way their debt or their equity was structured. So let's go to the next slide. I really don't need to introduce myself other than I'm merrillkaliser. You've been hearing me yap for a few minutes. A former corporate bankruptcy lawyer. Now I've got an SEC and commercial real estate firm. Those of you that have used us know Cindy and Greg and Tandy and Jeff really well. I started partnering with John about a year and 2 or 3 months ago, and we've been a little busy since then. And then I'll go ahead and pass it on to John.
Thanks, Merrill. I won't belabor this too much. I want to definitely jump into the content and most importantly, answer your questions at the end. But my name is John Monteiro, based here in Frisco, Texas, part of the Revision Masters team, full-time commercial real estate operator, acquisitions, developer. We have been extremely busy this last year. And based on our forecast for the upcoming years, we're still very bullish on the fundamentals of multifamily here in Texas. And so we'll talk about that a little bit later on in the webinar. But I'll hand it over to Anna.
Sure. Welcome. My name is Anna Kelley. I'm with Greater Purpose Capital. I have the honor of being John and Merrill's guest tonight. I'm also a multifamily syndicator. I've been in real estate for about 24 years. Before I went full-time commercial real estate, I worked in private banking with institutional investors, and I worked in product development for AIG, working on retail investment products for ultra high net worth investors. I'm a speaker and real estate coach and syndicator, and happy to be here.
Thank you, Anna. I think we'll go to the next slide. Okay, let's jump right into it. So let's quickly do a quick overview of 2022. I call this kind of the tale of two cities, or the tale of two halves. The first half of 2022 was much different than the second half, as I'm sure most of you know. So, obviously COVID-19, we were headed into our third year of COVID, still kind of continuing to linger, but definitely less of an impact to the economy in 2022 early on. We were still experiencing supply chain issues as a result of COVID, rising wages. So we've seen significant increases in wages as a result of the next bullet point, which is COVID stimulus spending. As we remember when COVID hit, the Fed and the government was handing out money left and right to consumers, to businesses, and to the banks. And as a result, that really kind of trickled in through the economy. And one of the results was the rise in wages. Obviously, huge tragedy here with the war in Ukraine. That started this past year and continues to be a hot spot in the world stage. That really has led to around the world some food shortages as well as energy shocks. With regards to Ukraine being the breadbasket of the world, and with Russia being such a large player in both natural gas and oil as well. Drilling down a little bit more, with COVID, corporate relocations and job population movements have continued to accelerate. We are based here in Texas, and we've seen a huge influx of both corporate relocations as well as inbound migration, as COVID has continued to affect a lot of the coastal states. And again, we've received a ton of inbound as a result. Rapid development, again, speaking specifically around Texas, we've seen huge development continue, whether it's single family, real estate, office, just a huge boom continuing into 2022. Rising rents, okay, we're multifamily folks, and we've seen massive increases in rents in 2022, over even very large increases in 2021. So as property owners, as landlords, we've really benefited from those rising rents. And then, the inflation really kind of started to peak, and the Fed really at that point decided they needed to cool down the economy and began to raise interest rates significantly. We've seen massive increases in interest rates going into 2022. And I think we'll continue to see some increases into 2023. We'll talk about that a little bit more in a bit. But definitely the interest rate increases have put a huge impact into the economy. Housing unaffordability. So as it relates to single family homes, prices have been continued to increase year over year, as well as with the increase in mortgage rates has really provided a huge increase in the mortgage payments, which is related, resulted in unaffordability in a lot of these housing markets. We've seen huge changes in lending. We'll talk about that here in a little bit too. And with regards to market volatility, everybody has kind of seen what's been going on with the stock market, the crypto market, et cetera. So just a lot of volatility going on this year. Next slide. Okay, so what do we kind of see happening in 2023? I'll go through these very quickly. We think that supply chains will be resolving. A lot of these issues are hopefully behind, the primary issues are behind us. We've seen a lot of deglobalization going on, especially with Russia and China really causing issues on the world stage. I personally don't think there's going to be a war with China. I was born and raised in Hong Kong. I follow the China market extremely well. However, you've just got to kind of keep that on the radar with all of the rhetoric coming out of China with regards to their wanting to take over Taiwan. We'll continue to see large corporate relocations. Interest rates are going to continue to be restrictive. When we say restrictive, they're going to continue to remain elevated, which I think is going to eventually lead to a recession this year. Don't know how deep or severe, but we think that that's definitely coming. Layoffs has already started, and I think will continue. We got recession on there twice. We'll keep going. Migration of jobs will continue again into the Sun Belt states. Construction and housing market declines are going to slow down. There's a lot of home builders that have put a pause on building. A lot of multifamily developers are also on pause right now. Rent stabilizing. The rent growth has definitely kind of started to slow down a little bit. We needed to see that based on the last couple of years. So that's a good thing. Lending is going to continue to be very tight, but we still see that there's an opportunity for growth with regional variability. Again, we see that Texas is really going to come out ahead. And I'll just leave it at this, that, as we look ahead into 2023 and look for opportunities, we will always invest or do projects based on fundamentals, not speculation. Next slide. Okay, very quickly. So we spent a lot of time talking about and looking at economic cycles. Very quickly, there's the long term and the short term. The short term is really kind of the cyclical trends. The longer term is what they call secular trends. Also look very closely at business cycles. And before COVID, the longest expansion in history in the U.S. was 11 years from 2009 to 2020. After 2020, or in 2020, I should say, the Fed began their stimulus program. Big stimulus program, as I'd mentioned, providing money to consumers, to businesses, to banks, and that really filtered into the economy, resulting in excess spending, growth, and inflation. So really some of the things that we're thinking about and looking at into this next year is, how long is inflation going to be at its elevated level? It peaked this year at 9.1%. The Fed's target rate is 2%. How long is it going to take for the Fed to get that number down through these higher interest rates, and then before they then pivot after that? So those are just some of the items on here. I'll jump to number 4 on the left. How will this impact my portfolio in multifamily? One of the things that we like about multifamily is it's based on fundamentals, again, not based on speculation. And so with all the population and job growth that continues into Texas, as long as we're good operators, good asset managers, good custodians of communities and residents, I think we're going to be well positioned to kind of come through this next year's recession and then on the backside into the next expansion period. Next slide. I think this is you, Anna.
Okay. So in order to kind of see where things are going, which is what everybody's asking, right, is when are we going to be in a recession? Are we already there? How long might it last? We really need to be able to understand all the data that's coming at us constantly from different talking heads and economists and news sources. And what I see a lot of is people see one economic factor and think that based on that, they can tell where we're going. And so one of the things that we're doing in trying to determine where things are going in the short term is really looking at the long-term economic trends first and looking with that wide lens to be able to see what's kind of the trajectory that things are headed overall in the U.S. economy. And what we need to really understand is that labor force participation and labor force growth really drive GDP, they drive inflation, and they impact interest rates pretty substantially. And so if you look at the period of the 1960s into the 1970s, when we had the last time that we had historically very high inflation, you'll see that we had the baby boomer population. And so we had a massive increase in the labor force participation growth. And because of that, these same workers who are at peak spending years were spending the most amount of money. That drives up production, drives up health of the economy, but ultimately drives up inflation as well. And if you look at the chart on the left, you'll see that GDP is very closely correlated with labor force growth. And then you'll see that CPI inflation is also very closely correlated with the labor force growth. But what you see since then, since it peaked in about the 1980s, is we've had this very long-term trend suggesting that we have falling labor supply, fewer people at peak working and spending ages, falling GDP growth, and falling inflation. And while that may seem a little sad that the growth is slowing, it also tells us that inflation is not at the same core risk level and height that it was back in the 70s, because we simply just don't have as much labor force participation, which we'll talk about in a future slide. Next slide, Jeff. Okay, so similarly correlated, as we saw that labor supply impacts GDP, we see that when there's a peak in the nominal GDP, we also see peak in interest rates. And you can see that the rising period during the same period leading up into the 70s, where we had really large increases in the labor supply, we saw increases in GDP and interest rates were high. So if you were a saver, you were rewarded with high interest rates. And if you were an investor, you might be hurting a little bit borrowing at those high rates. But once Volcker got rates really high to kill inflation back in the 70s, you can see that we've had this marked trend downward of growth and that interest rates have come down with it. Part of the reason for that is as less people are working and less people are stimulating economic growth through labor, through industry, through production, the Fed is basically stimulating the economy with debt, with monetary spending, with fiscal spending, and with interest rates coming down so that they can encourage the economy to continue to borrow at low rates to stimulate growth with debt when production is lagging. And so you'll see in the chart on the right that for every dollar of debt that is spent by the government, the amount of GDP they're able to produce is actually decreasing over time. So as population comes down, as real capita growth comes down, debt is actually going up, and it's less production per dollar of debt that's spent. And so what this means is that as GDP continues to fall, the government has to continue to stimulate more than they did in prior years, but increases in government debt also require lower rates over time to service such debt. Next slide, Jeff. So the other thing that the Fed does, in addition to raising and lowering rates to stimulate economic cycles and to manage these short-term cyclical cycles that John just talked to us about, is they use money supply, quantitative easing and quantitative tightening, to basically put more money into the system to stimulate growth or to take more money out of the system to stimulate a decline. And these gray bars in this image, if you look at them, these are recessions. And what you'll see is that typically the Fed starts to tighten money supply, bring money supply down. That tends to be followed by a recession. And then toward the end of recession, and this is important, it's usually toward the end of the recession, they start to increase the money supply again. And so if you look at the financial crisis between 2008 and early 2010, the Fed basically put in so much more money supply than they typically have for prior recessions. Up to 6% of GDP was into money supply. And you can see that for most of the period from 2008 through the pandemic, the money supply was elevated. It didn't really have downward trends other than a little blip in 2010. And so we've just had this unprecedented amount of money supply in the system stimulating growth. Then when we had the pandemic, 26% of GDP was actually federal stimulus money. And this unprecedented amount of stimulus is in part what has led to the massive spending increases that we're seeing and the inflation that we're experiencing now. And this is very much a part of what economists call a money price wage spiral. It's in full force, meaning the more money supplies in the system, the more we spend money, the more growth there is, the more prices rise, the more wages go up, and they're trying to stop that cycle. Jeff, if you want to go to the next slide. So just to underscore this, I want to show you a little bit about CPI and the components that make up inflation, because there's all kinds of data that target one particular type of inflation coming down or going up and saying that because of that one piece of data or that one type of inflation, then inflation is either tackled or it's going to continue. And so it's important to understand that the Federal Reserve really tracks four types of inflation: core services, core goods, energy, and food. And prior to the pandemic, they were pretty stable. Energy goes up and down, but everything else was pretty stable. And you can see during the pandemic, energy prices plummeted. The cost of most everything started to come down. And then right in 2021, suddenly we start to see this surge of increase of most types of inflation. We saw a small increase in food inflation, large increase in energy inflation, and largely this is timed with the timing of when Russia invaded Ukraine. It did cause an elevated energy crisis. It did cause more supply chain issues with food exports that we get from Russia and Ukraine, as well as fertilizer needed to produce food here. And so what you've seen is since the war in Ukraine and the end of the majority of the federal stimulus, all types of inflation have really gone up substantially, and it's really been historically unprecedented when we don't have large labor supplies like we did in the 1970s. What you can see is that inflation has started to tick down now that the Fed has been about a year into their tightening cycle and bringing interest rates up. Energy CPI has actually come down, and you would expect that that would have brought food prices down. It really hasn't substantially, but we hope that it will. But what you do see is that most of the decrease in inflation has really happened in core goods. And this is part of the supply chains easing up, prices going up to the point that people are saying, I'm not going to spend on this disposable stuff anymore. They're really prioritizing food and energy. But the last piece I think is really important for us to understand, and that's that the major part of inflation that's sticky, that's harder, and that's really the target of the Fed is core services inflation. And core services inflation is primarily elevated because people, after being shut down, wanted to start spending more for leisure. So we're spending more in eating out and hotels and traveling and other services, but also because of wage inflation. And so as people make more money, they're spending more time on services, spending more money on services, and the cost of those services have continued to come up. So that's really when the Fed talks and when Powell comes out and says, we need to get wages in balance, it's really this core services inflation that is kind of persistent that they're needing to target. And because of that, they're trying to slow down the economy, stimulate a little bit higher unemployment, a little bit lower wages to try to get us into this soft landing where we have depressed growth, but not quite a recession. Next slide, Jeff. So I want to point out 6 key factors that the National Bureau of Economic Research uses to date a business cycle and a recession, and to kind of show you where we are, because it's important, again, not to just look at one piece of data, but to understand the leading indicators that show us that we're heading into recession and those lagging indicators as well. And essentially, the NBER, when they determine whether we're in a recession, they look at these 6 things: real personal income, less transfers or government payments, employment, wholesale retail sales, non-farm payroll employment, real personal consumption expenditures, and industrial production. And the chart on the left shows a coincident index that's put together by Eric Basmajian. He is an economist that I follow who really tracks these coincident indicators together as a single index. And what the chart on the left shows you is that there has been positive growth in all of those 6 factors up until the pandemic, when you see that everything plummeted, we went into recession. But since then, everything has been growing and above baseline. The chart on the right shows the baseline of these coincident factors. And you can see that very quickly, since mid-2021, the coincidence of all of these things coming down at the same time is really pronounced. And you can see that we're finally below trend in terms of growth, meaning all of these things are pushing us into recessionary territory, with the exception of 2 things, which is employment and wages. But we're not quite at that zero line pushing us into a recession. Next slide, Jeff. So this is a really important graphic for you to understand. So along with the coincident indicators that we were just talking about that are not quite recessionary, there's 2 other categories of indicators that the Fed looks at and that economists look at to say, are we in a recession or are we not? And are we heading there? And how likely is it that we'll be there soon? So these longer leading indicators are things that start to get recessionary before we actually hit a recession. And that's monetary policy, the yield curve, and housing. And all of those things are clearly in recessionary territory. They've slowed down. Monetary policy is tightening because of where we are. And then you look at the shorter leading indicators, which are impacts on manufacturing, trucking, and labor. And you can see in this middle line that the shorter leading indicators are all really recessionary as well. So the only thing left to become recessionary in the factors that the Fed looks at and the NBER to date these recessions is really the payroll and employment number within these coincident indicators. And so the Fed will continue to raise rates until employment rises, wages start to decline, and this money price wage spiral complete their downward cycle. And as a result, I believe that we are highly likely to go into a recession in 2023 because all the factors except for wages and payroll are there. And it's just really important to remember that this is a short-term business cycle. So when people talk about going into a recession, it sounds really scary. When we think about what is that going to do to our vacancy rates or our rents or our values or our cap rates, this is very short-term. And as multifamily investors, we're looking out beyond just these short-term cycles. A recession on average lasts about 10 months with an 18-month recovery period, depending on how deep, how diffuse those recessions are. Next slide, Jeff. And just one more slide to kind of highlight where we are with the Fed trying to get wages and employment down. I think it's really important to talk about the labor force participation rate, which is a much more accurate indicator of the health of jobs than unemployment is, because unemployment rate does not take into account the people that aren't actively looking for work. Economists prefer, and the Fed prefers, to use an employment to population ratio, which really takes all people 16 years and older, the entire population, and says how many of them are actually working, regardless of why they're not, how many are working. And what we see is that this employment to population ratio is actually a leading indicator for wage growth across the United States. And the Fed is watching this number very, very quickly. And essentially, you would think that If less people are working, they can demand higher wages and wages would grow. But actually, labor participation is a strong indicator of the health of the economy. And you can see that as labor participation rates come down, this blue line, the wages actually fall across the board. A lot of that fall in wages is hourly rate employees, such as those in the service sectors where the Fed is trying to target and bring down inflation. But you'll see that it is a leading indicator. And actually, we now have a lower labor force participation rate than we did pre-pandemic. It spiked up, but it's coming back down very, very rapidly, as you can see on the tail end of the right-hand side of your screen. And wages, again, are following. So we expect that wages and employment will continue to drop until that completes this recessionary cycle, and that the Fed cannot drop rates to stimulate it out of a recession with a quick pivot until they get the wages and the labor force participation rate into the recessionary territory sufficient enough that they can bring inflation down to 2%. Once they do accomplish this and put us into a recession, however deep and long that may last, we expect them to pause a little bit and wait for inflation to drop down into the 2 to 3% range before they can really afford to pivot and get us back out of this cycle and back up to a growth cycle that they'll stimulate us back into. Next slide. And I'll turn it over to John.
Or Merrill.
Or Merrill.
John, don't worry. I'll take care of this slide. That's actually all of what you said, Anna. We talk about this weekly in our meetings with you, but it's very interesting. It's also interesting to see the lag of numbers after the Fed does some sort of quantitative tightening. It doesn't happen today. It happens today to all of us who are trying to get financing on deals or close deals, but all of these factors they look at in order to determine inflation, some of them are 2-3 months behind. It takes that long to filter through the system. So just to reiterate, you're much more knowledgeable about this than myself or John because of your background. But the reason the Fed's going to put a pause is they need to see, it's kind of like you're slowing down a dump truck without brakes. You're going to let it coast on its own. They need to see, how long it's going to take and how much it keeps dropping. They don't know how much it's going to drop when they stop. They might want to think they know, but they really don't know. And I think another thing that you hit on and John hit on real quick was there are so many different factors that are affecting the way we are, where we are right now, or where we were 6 months ago, that historically we really haven't had these. We never had a global pandemic shut down literally the world. We didn't have deglobalization. We've never had deglobalization. We had globalization. There was talk of slowly deglobalizing. COVID exacerbated that probably tenfold. And so now it's very interesting. I know this is not the slide, but we are going to talk a little bit. It's very interesting because sometimes the Fed and the actual government are not on the same page. You have our government that is increasing, bringing all the companies back here to the States. Okay, we've been outsourcing all the technology. You keep hearing about Tesla, Apple, every semiconductor. They're all moving either from China back to the US or China to India, but they're all coming back here. And there's, again, the government throwing billions and billions of dollars. I think it's $2 trillion just for semiconductors to come back here. But what does that do? It creates more jobs here. What kind of jobs are they? They're higher paying jobs. So it's hard to get your unemployment down, your wage rates down as the Feds. You're looking for those numbers. At the same time, you've got the government that is stimulating jobs, whether they intentionally had that or not. And then we've talked about it, and John and I talked about it a lot, and he put me onto this podcast. The end of the world is just the beginning, where, the economist spends chapters about the decrease in population. And the US has a decrease in population, which means less people to go out and work. So we don't have as many people to go out and work. We've been outsourcing it. Now we're bringing what we outsource back in. And so the Fed is looking for this magical, we want unemployment to be up here, kind of hard to get unemployment up here when you've incentivized the largest companies in our country to bring work and jobs back here. So it's very interesting, just not from someone who's trying to get financing and, trying to make sure everything else is working, but from a high level, it's like the Fed and the government are sometimes not talking to each other. Sometimes I think is more often than not.
Absolutely. And Merrill, just to underscore, Cal has come out and said, I don't know how long it's going to take. I don't know if it will be a deep recession because there are so many factors. Clearly, the writing is on the wall that we're heading there. The question is, can they get us back out of it? And is the job growth here because of all the deglobalization going to be so good that it gets us out quickly? But does that make inflation kind of start to come back? And that's what they want to avoid. But it's very complex.
Yeah, it's very exciting. I'm glad we're able to solve all the world's problems in an hour. And then I'm gonna talk about this slide, which I probably have the least knowledge about. I was joking around ahead of time. But basically what we're looking at is, this is a slide by Marks and Millichap. They actually produce a lot of good information. John and I and Anna like to follow out of their stuff. So when we use someone else's slide, we want to make sure we give credit to what they've put together. But this is basically just showing the Fed rate, how it has increased and decreased, and in comparison, the 10-year Treasury rate. And so I definitely will not say it the way Anna would say it, but basically the Fed rate is a shorter term rate, and the 10-year Treasury is obviously a longer term rate. And typically your 10-year is always a higher rate than your short term, and when your long-term rate drops below your short-term rate, you've got what's called a yield curve inversion. It's when basically rates for like a 2-year Treasury rise above those for 10-year note. And this has happened in the past. Matter of fact, every time that's happened, it's always been followed by a recession. There hasn't been a time where it hasn't been followed by a recession. And I think the first clear, I'm reading some notes I have too, first clear recession inversion in the last 15 years happened in July of 2022, this year. There were some tiny ones, 2019, August 2019, April 2022. Those were tiny and went back up. But here's the interesting thing, since July of 2022, the inversion has gotten larger. And that hasn't really happened. That's only happened one other time between 1978 and 1982, which was the big recession where interest rates went up to 17, 18%. I remember my father, even as a kid, when his mortgage went up to 17%, I thought he was going to lose his mind. So it's very interesting to see where it's going. And this is just another factor, another tool to look at. But again, you have to put everything together. Next slide. Okay, so we're going to try to talk about some positives. I know it sounded like Debbie Downer, doom and gloom. You guys know me, I'm always Debbie Downer. But so as Anna put very eloquently, recessions are always short. They're typically short term. They're always at the end of an economic cycle. I mean, typically economic cycles, just like the housing cycles, are 7 to 9 years. It goes up, it comes down, it always adjusts. Had it not been for COVID, that's one of the longest cycles we've had. And it would have ultimately come back down, probably not as abrupt. And you probably wouldn't have had a situation where the world pumped in trillions and trillions and trillions of fake money to try to boost, try to keep everything going, quite honestly. So, I mean, that's hard to have predicted. Recessions, they vary in depth, they vary in diffusion. And as John put, and we all know, most of us that are in certain areas, especially in the Sunbelt areas, even recessions are location-based as far as how strong and how impactful they are. I don't have the slide, but I was looking at it earlier today. When we had the recession in 2008, 2010, rents in Texas didn't go down. They went down just about every other state. They didn't go down. They stayed the same in 2008, 2009, but they didn't drop. And they started going up in 2010. I'm not tooting Texas horn, the horn of Texas. However, there's some fundamentals that you can look at. We'll go over them, which is the next section right here, recession resilient factors, that when you follow these type of fundamentals and look for these things, they help you make more recession proof. Nothing's going to be in a complete escape from recession, but clearly some are going to be hit harder than others. So you look for areas that have strong employment opportunity, large workforce. You know, here we are, we're talking about the demographics shrinking and the labor force shrinking. Whether you are, I'm not going to get political, whether you are for or against either legal migration or illegal migration, Mexico has the largest young working population anywhere, actually, I think right now, anywhere in the world. And we are fortunate, if need be, we can let people in legally or illegally, depends on which side of the fence. That's probably not a good example to use depending which side you're on. But so we have some tools, and the government knows they can use some of these tools to help adjust what's going on. I know Anna wants to say something. Oh, you unmuted. So then we also have a large consumer base. Again, I'm going to use Texas as Texas example. We just surpassed 30 million people. We're the second largest state, supposed to surpass California in the next 8 years. I mean, we have a massive influx of people, working people, huge consumer base. We have no taxes, income taxes, that is. So we have more money to spend, and our wages are relatively, well, they're above the median wage, and our expenses are still below the median in the US. Not much, but still below. So we have higher wages, which again is not good for what the feds are looking at, but it's a function of how our economy is doing. Relatively good schools and low crime. So I'm using Texas because I live here and we invest here. But there are other areas in the country that have some similar numbers, maybe not all, maybe some a little better, maybe some a little worse, but there are other areas. And yes, as John said, they seem to be around the Sun Belts from Arizona all the way up to North Carolina, but there are pockets in between where you look for these areas. They typically have always been recession resilient. Doesn't mean you're not going to feel a slowdown, but it's not going to turn into a Detroit. Next slide. I have nothing against Detroit. Recession resilience is just a continuation. I'm going to go through these really quick. You know, businesses and investors should be focused on longer term returns to get through this recession. We've, as investors and sponsors, have been absolutely spoiled the last 2.5, 3 years. Stupid returns. And the returns, I mean, we all got to enjoy them, but the returns were essentially a function of the peak of a business cycle, and then you add COVID on top of it, where just trillions of dollars are pumped in of free money and allowed everybody to increase rents. Everything went up, and right time to sell. Money was very cheap to borrow up until I think it was April 7th at 3 p.m. It was great. But that's not reality. If everybody goes back and looks to what was going on in 2012, 13, 14, 15, you know, investors making 12 to 13% on a deal annualized was a good return, aside from tax benefits. So business investors should be focused on long term. I think they already are. As we've all talked about, once inflation is conquered and recession materializes, the Fed has to lower rates, and they have every single time. They're going to be cautious, but they have, and it's also going to depend on, as John said, is there something going on between China and Taiwan? Is the war in Russia and Ukraine getting worse? You know, are there starving countries in Africa because there's no fertilizer being going on? You know, we did this to ourselves, sort of. The government cut off all ties with Russia instantaneously. Not saying we should or shouldn't have, but that in itself created a huge impact on our monetary supply, on our goods, on our services, deglobalization. So a lot of interesting factors. The downward trend, we've already talked about it. Population is down, labor force is down, GDP growth is down, which infers that ultimately rates will be low long term. GDP interest rates trended downward. Cap rates will follow downward as well once they trend downward. Ability to produce growth in the short term and long term will require you to essentially invest in areas with strong jobs and labor. We just talked about it. Core needs, which Anna talked about, housing, energy, and food. And where supply is limited, demand is high. Again, I'm not praising Texas, but I am praising Texas. We have a shortage of housing. We have our own energy. We have our own food. And we have an incredible labor market. And there are other areas just like that: North Carolina, South Carolina, Florida, Georgia, Arizona, Denver, Salt Lake City. There's some great pockets, and there's some great areas. We're not going to get too much into real estate for specific on this, but there's some fundamental areas that people should be looking at right now if they're looking to invest. Next slide.